Hey there, investors. Are you tired of the same old investment strategies? Do you find yourself frustrated with the lack of growth in your portfolio, despite your best efforts? Looking for a way to boost your income without breaking a sweat? Imagine a strategy that not only enhances your returns, but also provides a steady stream of income. Well, get ready to unlock the power of high-yield covered call ETFs. These financial instruments are designed to maximize your income potential while minimizing risk. Covered call ETFs are like the secret sauce of passive income. They combine the stability of dividend-paying stocks with the additional income from selling call options. They offer the potential for juicy dividends while letting you dip your toes into the exciting world of options trading without needing to be an expert. This means you can enjoy the benefits of options trading without the steep learning curve. These ETFs hold a basket of stocks and sell covered call options on those stocks. Essentially, they generate income by selling the right to buy these stocks at a predetermined price. Sounds complicated? Don't worry, we'll break it down in plain English. A covered call strategy involves holding a stock and selling a call option on that stock. This generates a premium, which is an extra income for you. By the time you finish reading, you'll be ready to supercharge your portfolio and watch your passive income soar. You'll understand how to leverage covered call ETFs to create a more robust and resilient investment strategy. So, stay tuned, and let's dive into the world of covered call ETFs together. Let's demystify covered calls. Covered calls are a popular strategy among investors who want to generate additional income from their stock holdings. It's a way to potentially earn extra money while still holding onto your shares. Imagine you own 100 shares of Apple stock. Apple is a well-known company and its stock is often a favorite among investors. You believe in the company's long-term potential and want to hold on to your shares for the foreseeable future. You're bullish on the company long-term, but you wouldn't mind some extra cash flow. Maybe you have some short-term financial goals or just want to maximize the return on your investment. This is where covered calls come in. By selling a covered call, you're essentially renting out the potential upside of your stock for a premium. It's like leasing out a property you own. You still retain ownership, but you earn income from it. You sell someone the right, but not the obligation, to buy your shares at a specific price, the strike price, by a specific date, the expiration date. This means that if the stock price doesn't reach the strike price, the buyer won't exercise the option, and you keep your shares. In return, you receive a premium. Think of it as upfront cash for selling those rights. This premium is yours to keep, no matter what happens with the stock price. It's an immediate boost to your income. If the stock price stays below the strike price, you keep the premium and your shares. This is the ideal scenario for a covered call seller because you get to keep the extra income and still hold on to your stock. If the price goes above the strike price, the buyer might exercise their option, meaning you sell them your shares at the agreed upon price. While you might miss out on some potential gains, you still benefit from the premium and the sale price, which is typically higher than your original purchase price. Covered calls can be a great way to enhance your investment returns, especially in a stable or slightly bullish market. However, it's important to understand the risks and rewards before diving in. Always consider your financial goals and consult with a financial advisor to see if this strategy aligns with your investment plan. Now, managing individual covered calls can be time-consuming. That's where ETFs come in. Exchange-traded funds, or ETFs, are like baskets of stocks that you can buy and sell just like a single stock. High-yield covered call ETFs hold a diversified portfolio of stocks and implement the covered call strategy for you. They do all the heavy lifting, collecting premiums and distributing them as dividends. Talk about passive income made easy. Why should you care about high-yield covered call ETFs? Here's the juicy part: high dividends. These ETFs aim to deliver higher-than-average dividends, putting more cash in your pocket. Passive income stream. Collect regular income without constantly monitoring the market. Downside protection premiums collected from covered calls can cushion your portfolio against market dips. Diversification. ETFs hold a basket of stocks, reducing your exposure to any single company's risks. Section 5. Finding the right ETF key factors to consider. Not all covered call ETFs are created equal. Here's what to look for. First, the underlying index. Does the ETF track an index that aligns with your investment goals? Next, yield. Compare the ETF's dividend yield to others in its category. Then, expense ratio. Lower fees mean more money in your pocket. And finally, trading volume. Choose ETFs with high trading volume for better liquidity. Section 6, Step-by-Step Guide. Investing in Covered Call ETFs. Ready to get started? It's as easy as 1, 2, 3. 1. Open a brokerage account. If you don't already have one, choose a reputable online brokerage. 2. Fund your account. Deposit money into your account to start investing. 3. Search and select. Use your brokerage's platform to find covered call ETFs that meet your criteria. Enter the ETF's ticker symbol and click Buy to purchase shares. Section 7. Managing Risks. Protecting your investment. In this section, we will explore the various risks associated with investments and how you can protect your hard-earned money. Understanding these risks is crucial for making informed decisions and ensuring the longevity of your investment portfolio. Remember, no investment is risk-free. Every investment carries some level of risk, and it's important to be aware of them. By understanding the different types of risks, you can take steps to mitigate them and protect your investment. Let's dive into the most common risks you might face. Market risk. The value of your ETF shares can fluctuate with the broader market. This means that if the market takes a downturn, the value of your investments can decrease. It's essential to stay informed about market trends and be prepared for potential volatility. Interest rate risk. Rising interest rates can make fixed income investments less attractive, potentially impacting ETF prices. When interest rates go up, the value of existing bonds typically goes down, which can affect the overall performance of your investment portfolio. Call away risk. If a stock's price rises significantly, your shares might be called away, limiting potential upside. This can happen with certain types of investments, such as options. It's important to understand the terms and conditions of your investments to avoid unexpected surprises. Diversify. Don't put all your eggs in one basket. Diversification is a key strategy to manage risk. By spreading your investments across different asset classes, you can reduce the impact of a poor-performing investment on your overall portfolio. Spread your investments across different asset classes. This means investing in a mix of stocks, bonds, real estate, and other assets. Each asset class has its own risk and return characteristics, and a well-diversified portfolio can help you achieve a more stable return. Long-term outlook. Focus on long-term growth potential rather than short-term market swings. Investing with a long-term perspective can help you stay calm during market fluctuations and avoid making impulsive decisions that could harm your portfolio. Do your research. Thoroughly understand the ETFs you're investing in and their associated risks. Take the time to read prospectuses, research reports, and other relevant materials. Being well-informed will empower you to make better investment decisions and protect your investment from unnecessary risks. Section 8. Real-world examples, popular high-yield covered call ETFs. Here are a few popular high-yield covered call ETFs. QYLD, Global X Nasdaq 100 Covered Call ETF. Tracks the Nasdaq 100 index and sells covered calls on its holdings. XYLD, Global XS and P 500 Covered Call ETF. Follows the S&P 500 index and implements a covered call strategy. JEPI, JP Morgan Equity Premium Income ETF, aims to generate income while mitigating downside risk. Remember, past performance is not indicative of future results. Always do your own research before investing. Section 9 Conclusion. Boost your passive income stream today. High-yield covered call ETFs offer a compelling opportunity to enhance your income and potentially outperform traditional dividend-paying stocks. While risks exist, careful research and a long-term perspective can help you navigate them successfully. So, what are you waiting for? Start exploring the exciting world of covered call ETFs and unlock a new level of passive income potential.